even buying a home these days can feel like an impossible task, but there's one simple thing that can potentially halve the time you pay down your mortgage. I was talking with my dad, John, the other day, a property investor and a mortgage broker, and he was talking about one single thing that can drastically reduce the amount of time you pay your mortgage in.
Thanks, Nicola. So the way you can reduce the time that you have your mortgage for and also the amount of interest you're paying is by making extra repayments in your loan. And you don't need to make a huge amount of extra repayments in your loan to save money over the long term. So I'm going to go through some figures with you now on how much extra you need to make to reduce your loan and the time it takes you to pay for your loan and also the interest you're going to be paying over that life of that loan too. So let's just assume now you're a first home buyer buying a house for $500,000 and you've borrowed 95%, so your loan's around $475,000, and I'm assuming an interest rate around 6%. But in saying that, rates are on the way down, and you can get cheaper rates than that at the moment. So if you wanted to reduce your mortgage from a 30-year loan term to a 25-year loan term, you only need to make extra repayments of around $50 a week. So an extra $50 a week, you're going to be saving 5 years off your mortgage and paying it off 5 years faster. On top of that, you're going to be saving a lot of interest on your mortgage too. If you were to pay an extra $125 extra a week, you're going to pay off your mortgage 10 years faster. So that's a huge amount of time that you're paying your mortgage off faster. And the other thing to take into consideration, if rates were to drop, which they are predicting a rate cut very soon, and let's just say they were to cut by 0.5%, that's actually around $150 per month, which is, if you divide that by 4.33, it's about $35 per week. Because you've got your loan now at, say, 6%, you can afford that. So rather than actually reduce your repayments based on what the new repayments will be when the rates drop, continue making your repayments at that same rate.
So then you can be ahead.
As what you're paying now, you're actually then paying off your loan faster. So that extra $50 a week isn't a great deal to pay extra per week and reduce and take 5 years off your mortgage.
So we said that we was going to halve the time that we pay the mortgage down. 5 to 10 years is not half.
You're right, Nick, and I was getting to that. The next one I was going to go into was how to save 15 years off your mortgage, which is paying a mortgage in half the time that you've got your loan for, which is normally 30 years. So to do that, you need to pay an extra $265 per week off your mortgage on top of the normal repayments to be able to pay your mortgage off in 15 years. So does that make sense, Nicola? So obviously every little bit, the more you pay, the faster you're going to pay it off. So your aim is to try to pay your mortgage off as fast as possible. So 5 years is around $50 a week, 10 years is $125 extra per week, 15 years is around $265 per week.
So what loan was this on again?
So this was on a $500,000 purchase and a loan of $475,000. So we talked about in a previous episode, Nicola, about renting a room.
So could that be a possible way of generating more income?
Definitely. So if you could rent out a room for $150 a week, if you put that towards paying off your mortgage, you're paying it off 10 years faster. So that's a huge amount of time off your mortgage and time you're saving there.
So some other ways that I could generate more income would be like working extra hours, saving on food, like Uber Eats and things, just basic things, back to the sacrificing.
Correct. So we all know that buying a house, you've got to make sacrifices. So less spending on takeaway, going out less, picking up that extra shifts at work, little things like that. Use that extra money putting it off your mortgage. So the other thing that we can talk about as well is how to do that. So when you set up a mortgage, you can have a redraw facility set up, which means you put extra money onto your mortgage, you're paying extra repayments off, you're saving interest there.
Yeah.
But that any extra repayment you're making, you have that available to you as redraw. So you can put, if you, let's just say you're
Say if I did need it.
Say if you did need it in the future, you could pull that money back out and buy a car or go on a holiday. So any extra payments you can make off your mortgage is saving you interest.
But then my mortgage will increase?
It would increase it, yes. But the idea is if you can pay it off, keep as much money on your mortgage as possible, save you interest. So the interest is calculated daily. So the more you have on your mortgage in your redraw, the better off you are because you're not paying interest on that money or having an offset account. So it's either an offset account or a redraw facility.
Okay.
So the more you've got in that account, the more you can put more extra money you can put in there, the more you're going to save and the more interest you're going to save. And the faster you're going to pay your loan off.
So it's just back to basics, sacrificing to save more, paying off your mortgage will
the more
decrease
you pay off
the
your
time
mortgage,
you pay it in.
You're saving interest and reducing the time period it takes you to pay off your mortgage. As rates are dropping, because you know you can afford more,
keep on paying
that same amount there.
And then that will decrease your years you're paying.
Yep, correct. So in the show notes below, there'll be a link where you can actually enter your loan amount, how much extra you want to make on repayments, and actually tell you how much faster you'll pay off your mortgage together with the amount of interest that you're going to be saving.
And you can also change whether you want monthly repayments or weekly repayments.
Correct, yep.
So, Dad, my biggest takeaway from this would be that if interest rates were to potentially decrease, you would keep your repayments at the same level and not decrease with them.
Definitely at the moment, with rates dropping, if you can afford to make extra repayments on your mortgage, still continue to make those repayments where you are now.
Because with interest rates dropping, you'll be able to
Pay off your loan faster.
Yeah.
So to give you an idea, a loan of $475,000, we're using a purchase price of $500,000, loan of 95%. If rates were to drop by 0.5%, it's about $150 per month that you're going to save off your mortgage.
But then if you can continue paying that, keep on paying that.
You can continue paying that, still continue to pay that amount.
Another key takeaway would be the basic stuff, sacrificing to save money and always trying to add more to your repayment rather than take away. Because in the end, you can also withdraw from your mortgage, but then that will obviously lengthen the amount of time you have to pay.
Yep.
I'm Nicola Kefalianos. I hope you've enjoyed this episode. And when you get into your first home, this helps to shorten your mortgage as much as possible. I'll see you on the next episode.